This is Nathaniel Pulsifer with Wholesale Income, and in many videos I've talked about different specific cases in our inventory that work to create more income, more safety, and more residual portfolio value for you. That's what the Wholesale Income Advantage is all about. I've got one specific case I want to highlight today that's absolutely perfect for a long-term income stream. Long-term income is really the key to this strategy, and by long-term I can mean 20, 25, 30 years, or even a little longer. Depending on your age, it may suit for you. Long-term income is great for investors in the 50, 55-year-old range who are looking to create a retirement income that they may outlive them, but it could pass to a younger spouse or it could pass to heirs. Actuarially speaking, somebody, a married couple, they have about a 50% chance of one of the two of them living to age 92. So for a 55-year-old, 35 years is not at all too long to be planning for. And the beauty of the wholesale income program that we utilize, we can create income for a very long time that's very stable, safe, guaranteed, and secure. And that allows the rest of your assets to perform in the stock market for growth and not be burdened by unnecessary withdrawals or withdrawals that are at an inopportune time. That's sometimes referred to as reverse dollar cost averaging. So when you can not have to worry about buying groceries from selling stocks when the stocks are down, you can make your portfolio stretch much, much longer than it normally would under a drawdown program such as the commonly used like 4% rule, things like that. So let me go show you a long-term income case and just show you how powerful this can be.
All right, thanks. So the long-term income stream case that I just mentioned is just an absolutely fabulous deal in our inventory currently available. This MassMutual payment stream pays for a beautiful long 38-year income stream, and it starts at roughly $2,200 a month. It goes up 3% a year. When you select this case and you see it on inventory, of course, you can put multiple cases together if you wanted to, and download a combined illustration, or you can see the single case and pull down its illustration and the payments table and the reservation form. So when you pull down these documents, the payments table in particular shows you each individual payment that's happening, and you can see that it goes up 3% a year every April 27th. So April 27 of 25, it goes from 224424 to 231157. That's a 3% increase each year. That's what 3% COLA means on our inventory. Just every year it's going to go up 3%. And this being a long, long income stream, you can see every April it's going up to 3% from the prior, the last payment in March. So this is all contractually guaranteed by MassMutual. In this case, the payment stream is assigned to you through a payment servicing company, and these payments are fixed, guaranteed, absolute. There's no variability in them. They'll be coming to you no matter what. Now, a lot of people look at 38 years and they say, oh gosh, I'm 60 years old. 38 years from now, I'll be 98. Why would I buy something that long? Well, a 60-year-old, I frequently run into situations where I have individuals who, let's say he's 60, she's 57, or, sometimes you have a much larger discrepancy in age between spouses. And actuarially speaking, one of the two in a married couple is going to live to 92. That's 50% of married couples will live. One of the two of them will live that long. So if you're 60, 98 isn't really out of the realm. One of the two of you is going to live at least to 92. In addition, there's always a consideration for heirs. There's a consideration. Also, it's worth considering the traditional annuity sales. I was going to say sales promise, but it's really a threat. It's more like a stick than a carrot. Most annuities are sold using fear tactics, like, oh my God, what if you run out of money? And that's how most annuity agents are going to sell lifetime income, be it a lifetime income stream rider from a variable or an indexed annuity, or a period certain immediate annuity. Sometimes the acronym SPIA is used. Most agents are going to be selling lifetime income based on fear, that you might run out. Well, the downside of lifetime income products is that they're really expensive and the payout is much lower. In other videos, I'll do an apples to apples comparison of, like, I'll pick this case. I'll do 38 years of income, period certain, guaranteed, versus a life with, I think the highest I can illustrate is life with 20 years certain, but maybe I can find a life with 30 years certain. And this is just going to pay out, frankly, it's just going to pay out a lot more dollars, and it pays out guaranteed. So you buy longevity protection with lifetime income streams, but it's typically use it or lose it. Your account value in an index annuity will be depleted to zero long before you get into those actuarial years in your late 80s and 90s. And if you die, there's nothing left. If you and your spouse both die, there's nothing left for your heirs. Whereas with this 38-year stream, you're effectively buying longevity protection because it goes perhaps a little bit past your life expectancy, but it's going to happen to you regardless. It's going to pay to you or your heirs no matter what. And so it's a much better deal overall in total financial output. So I got off on a little bit of a tangent on that because I sometimes hear objections about how a 38-year stream or a long income stream like this exceeds life expectancy, but it's really important to put it in perspective that it's a much more cost-effective way to buy longevity protection and to protect your heirs. So let's put that aside for a moment and let's talk a little bit about the wholesale income strategy, where I take a specific case and compare it to your typical Wall Street, what I call a 60-40 cookie cutter Wall Street method of investment. And that's where, your financial advisor will put 60% of your assets in stocks and 40% in bonds, and use a, quote, safe withdrawal rate, sometimes known as the prudent man's rule or the 4% rule. That's a fairly common withdrawal rate. So let's just go ahead and take a look at this case in that context and see how it plays out. So what I'm going to do is just select it, put it on my clipboard here, and we're going to go to a fresh, clean little calculator illustration here. So let's take a look at this particular case, and let's assume for a minute that you've got a starting portfolio of $1 million. Let's start by putting $1 million with enough zeros, and we're going to do an apples to apples comparison. You may want to withdraw more, you may want to take out less, but for apples to apples comparison, for purposes of this illustration, we're going to take a look at a $1 million portfolio. Now, I could run it a little bit lower. The result to be the same, and I'll show you in just a minute. So we're going to look at a monthly withdrawal here we're starting this at 22178. Okay. It's a pretty simple withdrawal rate of 2.6%, but like I said, it's not going to matter in the end. What we do to compare apples to apples here in these videos is to say your 60-40 Wall Street cookie cutter kind of stock and bond allocation. We use a tool called the Portfolio Visualizer. It's a free tool. You can use it as well. And it's a great way of illustrating all different kinds of scenarios as to what a portfolio is going to do. So in this case, we've got $1 million portfolio, and we said, what did we say? 2178 of monthly income. And we're going to run this thing, 38 years. I can run at 35 or 40. Let's just run at 35. And we're going to go up at 3% a year in inflation. The parameterized inflation brackets between 3 and 4, but I'm just going to go at 3. And what we're going to utilize here, instead of asset classes, you can use asset classes. Those would simply be like the U.S. stock market, the U.S. bond market. But I like to use specific tickers because they're more tangible and you can buy them. So I've got a couple of ones here. VFINX and VBTIX are two common ETFs from Vanguard. You can go and see the product detail on them right here. You can see what they're all about, their historical performance. And the VFINX runs 11% historical, and it's basically a proxy for the S&P 500. The S&P 500 itself is 11.9. This is a little bit less due to the very minor Vanguard fees. Same with this one. It's a proxy for the bond market overall. So we'll use these two, VFINX, and we'll do 60% in that, and we'll do VBTIX 40% here. I'm fat fingering the keyboard today. Okay, so now what we have here is your typical Wall Street cookie cutter 60-40 $1 million portfolio pulling out this exact same income as what the wholesale income contract can produce. We're going to run this simulation, and it looks at historical returns over time and how this portfolio is going to play out. This portfolio is pretty stable because it's not an aggressive withdrawal rate by any means. In the lowest or the worst case scenario, you'd end up with $1.3 million in real dollars after 35 years. In the middle case, 6.4, and in the best case, $17 million. These seem kind of crazy, these numbers. But in this case, 6.4 is the number we're going to use. And this is, remember, just for illustration purposes, okay? So I take that number and I'm going to stick it here. Now, why we do this is to say, all right, what if instead of a 60-40 allocation, what if we had a big wholesale income contract like this one, and all we did was invest the difference? So kind of like you heard about with life insurance, buy term and invest the difference instead of buying whole life. Instead of buying a 60-40 asset allocation, buy fixed income, invest the difference. When you have the fixed income, if it's supplying the income you need, instead of withdrawing off your portfolio, you can take this 431, you take that 431, and you have no withdrawals that you need to worry about. We're going to run it for the same 35 years, and I don't need the bond allocation in here. I'm just going to run 100% in the growth allocation, okay? Because you've bought fixed income, you've bought safety, you're going to invest the difference for the long run. Where do you think that's going to play out? Well, they're going to be big numbers because you're basically just putting $400,000 to work in the market and leaving it alone for 35 years. Well, in the best case scenario, or in the worst case scenario, it's almost 4.7. 52 is crazy. But we're just going to look at the 50th percentile, middle of the road. Now, I think that number is a little bigger than the one that we had before. Yeah, it's actually 150% more. The numbers, every time I do this, I start to feel like I can't believe this myself. We beat the pants off of your traditional allocation every single time. And the reason is yields right now are fabulous on fixed income. This 6.5% yield, I haven't been able to offer 6.5% yield on these contracts in the 13 or 14 years I've been involved in this marketplace ever. I mean, these are incredible. This yield is so good and it's so solid that it puts this rock solid foundation under your portfolio and lets you go forward for, in this case, 30. Actually, I ran the illustration at 35 years. This payment stream pays out for 38. So you get 3.5 years of extra bonus, just not even accounted for in this illustration. So in the middle of the road illustration, 50th percentile, you end up with 150%, 154% more income at the end of the day than you would if you took the basic Wall Street advice. And this relatively low withdrawal rate. Maybe $1 million isn't the right starting point for this one. Let's say it was $750,000, or even $600,000. It doesn't matter where you're starting with. The concept here is that you're buying cheap, you're buying wholesale, you're buying income at a wholesale price, you're investing the difference, and almost any way you slice it, invest the difference, leave it alone, let it grow. You're going to be much better off at the end of the day than using just the Wall Street typical stock and bond allocation. It just works every single time. And this case is an incredible example of it, just because it pays so much money over so long and so securely. It's just a fabulous income stream. So however you want to slice it, I'm happy to work with you in your specific situation. We can go through one of these calculator illustrations on your situation and pick different, if there's different stocks that you like or whatever. I'm not a stock picker. I don't give investment advice. I sell fixed income. I'm just doing this for illustration purposes, but it's an incredible illustration that works every single time. And I sometimes like this, it just blows me away how much better we can do using fixed income instead of the advice that most people get. So anyway, my name's Nathaniel. Wholesale Income is your source for these higher yield fixed income payment streams. And I look forward to working with you. Thanks so much.